Good afternoon, everyone. Jason here. Today is January 18th, and this is your aftermarket update. All right, I'm going to do a couple of things. I'm going to do one thing a little bit different here for you today. I am going to go through the trade of the day. We did have a nice 62-tick trade of the day. It was our second trade of the day. The first trade was a break-even trade on the CL, and the second trade was right after the inventory number, and we were able to get into a nice 62-tick trade. Now, we did have a losing day yesterday, and so in the trading room, I took some time to go through the OTG Risk Analyzer spreadsheet, and it is in that spreadsheet that we're able to talk a little bit about our risk management philosophy, why that's important. We're going to then give you some very good risk management examples in this spreadsheet. So there is one thing that a lot of you do, and that's take one trade off at one position and then let the other one run. I'm going to show you how that might not be the most effective way to break down your particular trading style. I'm going to show you that in this risk management, risk analyzer spreadsheet. So kind of the way it's going to work here is I'm going to go through kind of the trade of the day here. Then I'm going to show you that trade of the day, and then we're going to transition right into that 25-minute discussion on risk management that's at the end of this video. So I'll try to keep this front part short because I do want you to hang around and watch that last 25 minutes on the risk management spreadsheet. All right, so we got into a trade here. We have what we call the 9 a.m. to 10 a.m. swing zone today. That is this blue area. So if you're not familiar with that on the CL, there's a time frame, what we call the swing zone, that happens between, again, 9 a.m. and 10 a.m. Central Time. And so we watch for market reversals and reversal patterns. Today you had the crude oil inventory report that came in today right here at 10 a.m. The market comes right down into this 44, and we were looking for the market to rally up over 59. Now, I don't trade immediately after the report. And so initially after that report, you had this long bar up here into this daily structure signal. And then we were watching our daily structure target here, resistance / support area, right? So you can see that we came down into that earlier in the session. It did rebound. We did dig through it. And then again, this 59 is our daily structure target. It's kick the signal, pay the target, one of the memory trick nomenclature that we use here. The other thing that we were looking at is if you just draw a straight trend line down into this zone right here, right? So you connect those two dots or connect these 2 points, and you have a pretty nice trend line here. We broke that trend line to the top side here, pulled back into it, could not make a new low past this swing bar here, allowed me to get in right here at 59. Our initial target today was up here at 01. We talked about that initial target being 01. Market rallies as high as 08, and I ended up getting stopped out around 89. Now, one of the reasons, again, that we were looking for this target up here, we had a couple of reasons, but the primary reason here was this was our daily structure mid, and we knew that if we made it through the daily structure signal here today, we should reach out into that zone there. So again, fairly simplistic approach, right? Trend line break, come back down, pull back into it, pull back that into a known support area, which is our market maker levels. And then, of course, the market rallies all the way up into that zone. So we had a 10-tick stop. We got in actually at 58. We had a 10-tick stop to 48. The market comes down to 51, missed us by 3 ticks. And then we ended up getting taken out at 89, which is a 3-to-1 risk reward. That 3-to-1 risk reward, I want you to keep that in mind when you go and watch the spreadsheet analysis that OTG Risk Analyzer at the end of the video. I want you to keep in mind that 3-to-1 risk reward. It'll make a lot more sense as to what happens in the big picture perspective when you have 2-to-1, 3-to-1, 4-to-1 risk reward ratio. So again, not only are we telling you in theory that that's what works, we're also showing it to you in practice here in front of a live audience. So having said all of that, here's what's going to happen next. The next thing you're going to see is a video of the trade of the day. I've cut that down. It lasted about 25-30 minutes. I actually cut it down into a minute and a half just so that we wouldn't spend a lot of extra time on that today, so that I could quickly get you into that risk management discussion and the OTG Risk Analyzer spreadsheet. So without further ado, here is that OTG trade of the day. Right here at 58. 58 long. There's 58 and I'm in. The stop here will be 10 ticks to 40. Well, what is this low here? Hang on a second here. 51. 48. 48 is the stop. 10 ticks on the stop. 10 ticks to 48. The target right now is, your target is 01. Right? Your target is 01. here. All right, so I'm going to bring this over here, okay? Make sure everyone can see this. Can you see the screen okay here? Making sure you can see. I'm on the CL screen. Can you see this screen okay? And I know for those of you that are regular room members, you've seen this a lot, right? But it's always good to get a little bit of perspective here. So what this, let me just tell you real quick here, and I'll do this here for a second. This spreadsheet is designed to do one thing. It's actually two things. It's designed to show you what will happen when you run what-if scenarios through it. It's also designed to help you understand what to expect from your particular performance. So we're going to do a little bit of both here in just a minute. All right. So if you're a guest in here today, I need to give you a little bit of background as to why I do what I do. So we're all about risk reward. Cut the losers short, let the winners run. When you cut the losers short, you get out of trades that are not working. Your win percentage is going to be low. Okay, I'm just telling you, it's just the way it is, right? So if you're getting out, if you're getting in a trade and you're getting out and you're getting out and you're getting out and you're getting out, right? You're going to have a low win percentage if it's not working, okay? When you let the winners run, you're going to have a higher reward ratio as well, right? So if you're cut the losers short, let the winners run, you're going to have a low win percentage. But when your reward is in line with your risk, you're still going to be okay, right? And so to that end, I'm not a guy. I am a guy. But to that end, I'm not a trader who takes one off at 10 ticks and lets the other one run. Again, a quick story. Just the quick conversation that I have with traders. And again, if you're a guest, you've not heard this. If you're a regular room member, you've heard it, in Austin Powers' voice 1 billion times, right? But here's the deal. I get asked, do you scale in or scale out? Do you scale out of your trades? Like, do you take one off at X number of ticks or whatever? And the answer always is no. But then I ask, the next question is, what do you do? Well, typically speaking, the average retail trader takes one off at whatever number. Let's call it 10 ticks, right? That's kind of the average that I get is when you're trading the CL. Is I take one off at 10 ticks. And then I always ask, where do you let the other one go off at? Where does it go off on average? Well, I don't really know. Okay, so I dig through the numbers with them, and I've done this 100 times if I've done it once. And typically what happens is we find out that the average secondary lot goes off at about 5 to 6 ticks. And so if you take one off at 10 ticks, that's $100. And the second one average goes off at 6 ticks. That's $160 on 2 lots. Multiply that times whatever number you trade. Okay. So if you trade 4 lots, double it, 6 lots, whatever. Okay. So if you take one off at 10 and the average goes off at 6 ticks, then you're averaging $160 or 16 ticks per win, 8 ticks per contract. So with me so far? Okay, cool. Now, there's your 80 level daily structure signal here. So I missed that down there. Take that long area off the chart. I missed it. We missed it by a tick. So I didn't take the ES, and I missed my running trade here by a tick. So we are about 10 minutes from the top of the hour here. So I'm going to continue with this process here. So I always ask, what's your stops, right? I always ask, what's your stop at? Well, I get anything from 12 ticks to 20 ticks, right? So let's just kind of cut the difference and say it's a 15 tick stop. Then I ask this question. If you're willing to take some off at 10 ticks and then one off at the other one averages at 6 ticks, do you do the same thing with your stops? And the answer is always no, Jason. I take a stop. Okay, so I'll take my stops. So in essence, you're taking a full stop and you're mitigating your winners. So instead of doing just the opposite, let the winners run, you're cutting the winners short, letting the losers run all the way to the stop, okay? And there's some of you out there right now going, yeah, that's me, right? And that's okay. You can do that and still be successful, but your win percentage has to be much greater if you're risking 300 to make 160. So 15 ticks times 2 lots is 300, and we just said that you take one off at 10 and the other one goes off at 6, that's 160. You're risking 160 to make 300. Not a great risk-reward ratio, right? So if I presented you with an opportunity, okay, if I presented you with an opportunity in another environment, that type of risk-reward ratio would not be something that you would be that interested in, right? Especially if it was a high-risk investment like trading, as an example, right? What's supposed to happen is high risk, high reward, not high risk, low reward, right? You're not trying to do those kinds of ideas, right? So that's a concept that is going to be tough for a lot of people to kind of get their heads wrapped around. But at the end of the day, if you're risking 160 to make 300, I want you to flip that. I want you to risk 160 to make 320 or 480 or, right, or keep going like that, right? That is what I would like to see you do. So let's take a look at this in real time, okay? So we're going to come over here and I'm going to show you what this spreadsheet does here for you. First of all, we're just going to set this up. We're going to set this up as, let's see if that's the right view. Yeah, you can see this. Okay. So we're going to say your initial equity here is $50,000, not $5,000. We're going to say $50,000 here. Hang on. That's your initial account balance. Okay, we'll just start there. $50,000. I'm going to do this wrong again. All right, nope, there it is. Okay, and let's say that you're taking a risk of 11 ticks per trade on the CL. We'll use this as a CL example. So if you have 11 ticks times 2 lots, that's $220, right? So if you say $220, divide that by 50,000, which is your initial account size, you're risking 0.0044 per trade, or 0.44%. That makes sense? Right? So you're risking 0.44% of your account, and you can do these numbers for whatever your account size is. Okay? But if you're at 0.44% risk per trade, that is very low risk per trade, right? And so what we say is the minimum commission per contract is going to be $10. That includes slippage and some things like that. So commissions aren't always $10, never $10, shouldn't be $10. And slippage doesn't happen on every single trade, right? But this gives you a factored in idea of $10 per trade, right? Okay, so let's do this. Let's say that you've got a trading system that is like we just described, right? So for every time you win 160 and you're risking 300, okay? That's a 0.53%, 0.53 risk reward, okay? And let's say you're winning 62% of your trades, and just for the sake of easy math here, we're going to say you're losing 38% of them, and you're at 0 break-even trades. Now, these numbers aren't perfect, and you can plug in your numbers that match your style and you know exactly what it is that you're doing. But let's just take that example. 0.53% is your risk reward. So again, you're risking 160, and at 15 ticks, you're $300. So you're at a 0.53 risk reward. And when you lose, you're losing 1-to-1. Okay. All right. So we're going to hit reset. And so now when I hit this start button and run all trials, what it's going to do is it's going to simulate mathematically, and the numbers are different every time you do it, but it's going to go through and it's going to process hypothetical trades. What would happen over the course of 100 trades with this particular mathematical formula being randomly distributed over the course of 100 trades? What can you expect your results to be from a mathematical perspective? Okay, so we're going to go run all trials. All right, so you won $781 with a 62% win percentage, okay? So you won, that's not bad. I mean, you didn't lose, right? And that factors in commissions and everything like that. So you won 62% of your trades and you made $781 based on 2 lots, okay? So that's trial number 1, 62%. equals 781. Now, that doesn't give you a super good cushion, right? And you won 62% of your trades. And so winning 62% of the time, if you've traded for any length of time, is a pretty good clip, right? That's a pretty good clip, right? And so let's take a look here. You've got a nice little run of green and stuff like that, but because your risk reward is so low, you're not performing very well, right? $781 isn't a ton of commission. And I know the way that most people think. They didn't sign up. I didn't sign up to sit here all month to make $781. And you know that if that win percentage comes down even a little bit, it's going to be a problem. Let's run it again. We'll hit reset, start, and run all trials again. Okay, this time you took a loss of almost $2,900. So we'll round down though and say that it's $2,800, and your win percentage was 60%, and yet you lost $2,800. Okay? Well, that sucks, doesn't it? That's not great. I won 60% of my trades and I still lost money. How is that possible? You might ask yourself. Well, it's possible because your win ratio is way out of whack, right? So let's do this, okay? Let's do this a little bit differently. Let's say you have an 11 tick stop, right? And you still have that one off at 10 and one off at 6 theory. So we're going to say 160 divided by 220, okay? And we're going to make this a 0.73 risk reward ratio. Whoops, I need to reset this. Reset. We're going to make that a 0.73. So what I'm doing here now is we're saying, hey, you know what? I've taken my stop down a few ticks to 11 ticks on the CL, and I'm still going to win that same 62%, and I'm still going to take one off at 10 and one off at 6. Okay, so we're going to hit start. We're going to hit run all trials. And at this point, you're at 62% and you won $469. Okay, $469. Yay, still positive, right? You get the point. You have to win a lot when your risk reward is in that kind of ratio, right? You have to win a lot in order to just get to break even. You have to win 62% of the time. So let's move this up one more time. We'll do one more little test here. We're going to move this up to 66%, okay? And we're going to move this to 34% and say, hey, you had a little bit better run at it on an average. And we're going to reset. We're going to hit start, and we're going to run all trials. And then I'm going to show you some other stuff here, okay? So that is a growth. That's, again, it comes back to 62%. The reason it comes back to 62% is because it's an average over the course of time. So some months you do better, some months you do worse, and again, it spit us back out at 62%. So let's go back up here. We'll reset, start, run it again, see if we can get something a little bit closer to spit out here, closer to that 66. Okay, so this is 60% and you lost $300. Okay, you get the idea, right? You get the idea. Okay, so let's do this. 60% minus 301. All right, so I'm going to do this for you here, okay? We're going to do something else. We're going to go... Now we're going to flip the switch here on you. We're going to flip it around on you here. We're going to say our risk-reward ratio is 2.25 to 1. Not 3 to 1, a little bit better than 2 to 1, but 2.25 to 1. This time, we're only going to win 35% of our trades, okay? We're going to break even on, we're going to lose, let's see, on this you'd probably break even about 15% of the time, okay? So let's go 15% of the time you're at break even. Whoops, I need to do it here. And let's see. Why am I having so many problems? 15 is the break even, okay? And that gives you 35 is 65, so 40, 50. So 50% losing trades, okay? So you're at 100 trades now. 50% of your trades are losing. 65% of your trades are losing or break even. But when you're getting out and you're holding on, right, at 2.25 to 1 with those areas, let's hit reset. We'll hit start, and we're going to run all trials here. And your win percentage is 35%, okay? Your win percentage is 35%. and your profit was $676. That is in line with winning 2-to-1, right? That is right in line with winning your 2-to-1 risk reward at that level, right? So if you think back at $781 at 62% is what we did earlier when you were at that 0.53. Now you're at 676 with a 2.25 to 1. There's a lot less pressure on you, right? There's a lot less pressure on you when you are winning at, you can win a lot less if you're holding on for the bigger targets, right? So I'm going to do this here for you. I'm going to come in here and I'm going to plug in this at 38% win rate. We're going to move this number down from 50 to 35. And we're going to make this, 40 rather, not 35. We're going to make this 40. Again, this is the what if scenario. Then we're going to come in here and we're going to make this about 22% break even. The reason I'm selecting these numbers is these are pretty close. Okay, these are pretty close to my numbers over the last 6 months. You've got a 16% is break even, 51% losing, and a 33% win rate. Right, but yet the total gain and loss over that period of time is on 2 lots is, this is my trader view, by the way, statistics, in case you're wondering what that is. Okay, hang on 1 second here, guys, just 1 second. Sorry about that. Sorry about that. I had a package delivered here. Okay, so again, 38% win rate, 2.25 to 1 risk reward. And you come in here and you hit reset. We'll hit start, okay? And we'll hit run all trials. And this will give you $7,500 at a 37% win rate at that idea. So think of that. 2 lots, 37% win rate, and you have a $7,500 profit, including everything, fees, commissions, all of that kind of stuff, right? And that, so you never got close to that with a 60% win rate, but this is at a 38% win rate. But here's the key. Here's why I call this the desktop psychologist. Let's say you came in right here, okay? This is trade 16 to trade 27. That's 12 trades, okay? You won 2 trades out of that 12. 2 divided by 12 is 16%. That's 84% losing ratio there, right? 84% of the losses. So if you come in at trade 16, your first day with us is trade 16, you see that loser. Then you see a winner, you go, okay, we're good. Then you say, okay, 18. By the way, I trade about 4 times a day. And so then you see trade 18 as a loser, and then trade 19 is a winner, and you're pretty good. And then you come back for day 2, okay? And then you come back to day 2 and you see 1, 2, 3, 4, 5, 6, 7, 8 losing trades. And this is the comment I get. This is a real comment, okay? What I'm about to tell you is a real comment that happened yesterday. Oh, I can draw trend lines on my chart and lose myself. I don't need to do that. I don't need to see you draw trend lines and lose. Yeah, you're going to lose. It happens. It's life. It's part of trading, right? But that was a real live comment that came in yesterday. Well, I could draw trend lines on my chart, fib levels and trend lines and lose myself. I don't need you to do that. Okay, you're right. You don't. Right? You don't. You don't need that. Yeah, Christian, really. Yes, really, that was said yesterday. And so, yes, when you come into this place right here and you see this, despite the fact that the system won $7,500, there was still a patch there where you lost. There was still a patch there where you lost, I don't know, 240 times 9. 240 times 9 is $2,100. Yet the system itself, based on that idea, performed at $7,500 on a 38% win rate, okay? This is why this is the desktop psychologist. Look at this run right here, okay? This is run 60. We'll do 60 down to 80. That's 21 trades, of which you only won 4. 4 divided by 21 is a 19% win rate. That means you lost 80% of the time on the same statistics that I showed you made $7,500, okay? On the same exact statistics where this chart made $7,500, you had a 20% win ratio from level 20 down to 80. That's 21 trades. if you bought, here's why this system will save you thousands of dollars. If this is day one in your brand new system, 60, let's see, 1, 2, 3, 4, 5, 6 trades, you lost 4. 4 divided by 6, it's 66% loss rate. You bought it. Here's what you're doing automatically. Here's the first thing you do. And you know who you are. And I've been one of them. Thing's broken, right? Let me do this. Let me add this moving average cross. Let me add this Ichimoku cloud. Let me add this Gann fan. Let me add this whatever, your favorite whatever. Let me add all this to the charts because you know what? This thing needs to be tweaked. And then you go here and you go 1, 2, 3, 4, 5, 6, 7, 8, 9 trades in a row you lost. Then you win 2 and then you lose 1, 2, 3, 4 more. So that's 15. You win 2 out of 15. You have thrown the system away. You have gone to your message boards and say, this room sucked. That guy can't find his ass. If you spotted him a cheek, it sucked in there. Okay? That guy sucks. Right? This system sucks. This program sucks. I'm moving on. That's what you do. That's what we all do. Okay? But yet I just showed you how this system how this particular approach made you $7,500. If I said, hey, you're going to make $7,500 on this thing, all you have to do is win 38% of the time, but you have to have a 2.25 risk-reward ratio. You would all say, cool, sign me up. But if I said to you, hey, you're going to get into this thing and it's only going to win 38% of the time, and you're going to have a period where there's going to be some drawdown periods inside of this thing that are going to be pretty nasty if you're not ready to handle it, right? And you're not risking a ton. You're risking 0.44% per trade on a $50,000 account, which is not a lot of risk. You can live a long time risking 0.44% of your account on every trade, 0.44%. Not 44%, 0.44%. And you're going to be able to get through all of those downs so that you can get to the up, right? So if I said you're going to lose or break even 62% of the time, you would tell me that's a broken system. If I said, hey, you're going to win $7,500 on 2 lots over the course of a month, you'd say that's a great system. It's the same thing, right? So yesterday we lost. It happens. It's life, right? That's over 100 trades won, which is basically, for me, it happens to come out to about 25 trading days. I trade 4, 5, 6 times, something like that. So that's 100 trades. So if you're a micro scalper, Juan, and you trade 25 times a day, then it's only a 4-day period, if that makes sense, right? It's only a 4-day period. But that would be over the course of a month if you were going 2.25 to 1 risk reward versus that all-in scale-out mentality.